Guys, this is the beginning of 410, and I want to just discuss something with you first. Um, these journal entries are maybe a little bit more complicated, if you will, a little bit more sophisticated journal entries than you found maybe in the first assigned problem in this class. So I just want to kind of talk you through the journal entries and the kind of solution that's in the author's material. So we'll just take a close look at it and go blow by blow and just kind of discuss it a little bit. I think it'll help you. You'll see here that there is a net income column here. And just remember that expenses are often decrease, they always decrease net income. Um, and that revenue typically increases net income. So it kind of shows this here, but this really is a solution portion that I don't really cover very well because I think it's confusing to students, to be honest. So I'm going to scroll down here, guys, just a little bit to the essence of what the journal entry looks like. Because when you go directly to that, then you're just a whole lot better off. Now, when I get to these journal entries, I'm going to talk about these a little bit. The first one can get real confusing. Let me talk about it just a bit. We have been buying supplies, and then we create an asset out of that supplies, and then we pay the supplies, or we accounts payable to the supplies. We've been debiting, if you will, a supply account, and then we are crediting, whether we use cash or we buy them on credit, accounts payable. Now, some companies don't do that. So some companies, what they do is they go ahead and debit supplies expense whenever they buy supplies. And they don't kind of like keep an inventory of supplies. And so then at the end of the accounting period, they've got to do kind of a reversal and kind of take some that they have on hand out of expense and put it back in a supplies account so that it shows up on the balance sheet as an actual asset. So we'll look here again and we'll see here that we've got to do a journal entry that is putting supplies, if you will, on the books, because you haven't done that yet because you've been just debiting supplies expense every time you purchase supplies. And you have this an amount of $700 that's left over from the ones that you use. So see, you used up 1,900 of them, and so you've got 700 left. So you've got to kind of put those on the books as an asset. So you're going to debit supplies expense, and then debit supplies, and then you're going to credit supplies expense because you got to decrease the expense because you got too much expense in there because you still have those supplies on hand. Now, this is kind of an alternate way in order to record the purchase of ordinary supplies that you may use in a business, but it is not necessarily mainstream. But what the author's trying to do here, and accounting authors do this again all the time, is they're trying to show you a little bit different way because some of these ways are still generally accepted, but they're just a little different. And we'll run into in this same problem a journal entry that will be recording it the way most companies do in just a couple of minutes. But right now I want to go to B, which is this retained earnings here. And I want you to realize that you haven't been introduced to this yet. We're going to talk about this more later. But anytime that we issue some dividends that we're going to actually physically pay out as a cash dividend, then we have to take those dividends, if you will, out of retained earnings. So when you debit retained earnings, this is decreasing the equity account, and then you're increasing a payable account by crediting it. So in other words, what you've done is you voted to pay some dividends, but you just as of a certain date, but you're not paying them yet. You may be paying them next month, and not, or maybe a couple months later you're going to pay that amount. And sometimes the companies will actually announce what day they're actually going to pay, and there'll be a date on record, like all stockholders as of a certain day will then get paid, um, down the road. So we're going to record that as a payable. If you'll look at C in this particular example, employees were paid so much in wages for their work. So it's a wages expense and it's cash. Now, guys, this is a very typical ordinary journal entry. But then they give you D right behind it. And what this is this is an employee that's getting wages for the last week of the month, but they haven't been recorded as an expense yet. But we're also not paying that employee until next month for this particular week. You see, sometimes the pay period doesn't line up with the accounting period. So in that case, then we would take the wages expense and we would make then a wages payable out of that amount so that we can record that and it could show up. Remember, at that point in time on the balance sheet at the end of the accounting period, that wages payable would be there, knowing full well that when the employee gets paid, we're going to have to credit that wages payable. We debit it, excuse me. We're going to debit that wages payable then, right when that those employees get paid. So number D is a very, very typical journal entry that's done as an adjusting entry at the end of the accounting period. Okay. Now in E, we have revenues from service performed, and we've got partial payment coming in, right, in cash. And then we have here $12,900 that's owed to us. But understand that we have earned this service revenue even if we haven't gotten the cash for it. We've earned it. So therefore we're going to go ahead and record the revenue in full, and then we record an accounts receivable that we're going to receive this money later. And then of course we also record the cash that we get. Remember that advertising expense is simply something that we advertise, is always recorded as an expense. It's never recorded as an asset. This is one of the big breaks, guys, between us and the international standards, is that some of the advertisement they kind of deem measurable and they try to capitalize some of it and make it into an asset. But we don't do that in the United States. That's not American GAAP. We expense all advertisement because we don't feel like we can measure the effects, the direct effects of the future on advertisement. And so we just don't try. So we just go ahead and expense it whenever we spend that money, or we order that service and we know we owe it. That's when we record it as a payable here, as it is an F. Okay. Now, if we have a sale and we're using what is referred to commonly as a perpetual inventory system, which means that, when Walmart, I've mentioned this before, scans those items, you immediately record the sale, but you also record the cost. Well, in general journal format, you'll see here, you're recording the sale and then you're recording the cost. So what we're doing is we're recording the sale first as revenue here. The accounts receivable and the cash, just like the previous E we were looking at. But then you also record the cost of the goods sold that we sold, and you adjust inventory for it. So we're using the perpetual system, and we'll talk about this more later. You have to make a journal entry because you immediately cost the goods that are sold whenever they are sold. So whenever you record revenue as sold items, then you have to go ahead and adjust inventory and adjust your cost of goods sold. If you'll notice in H, they have an independent transaction from transaction A. And in this case, we have been taking supplies and we've been putting them in supplies. So we have to make a journal entry, an adjusting entry for the supplies we have used up, if you will. So in this case, we've used up 990. So we expense them by debiting them, and then we adjust the supplies account by 990, and we decrease our asset account by 990. Now understand, this is different from A because you have been recording these supplies as assets, and now you're taking them out of the asset and putting them in expense is what you're doing with this journal entry. Now sometimes, guys, we have a receivable, an interest on maybe a note that's been given to us, and if it comes to the end of an accounting period, usually you get the interest, when the note is paid off. That's when you get the interest. But if we have any interest that is due us at the end of an accounting period, we're going to make an adjusting entry to go ahead and record that interest as revenue. And of course, we're not receiving the interest yet, so we have to book it as a receivable. So you'll see here in I, we have interest receivable of 540 and then interest revenue of 540. Now, in J, we're going to issue 1,200 shares of $10 par value stock for 26.4. And then, of course, we have an alternate solution here. And I like the alternate solution better because stock very seldom ever gets sold for par value. It's typically over that. So if you'll see here, we're going to get 26.4 in cash, and then common stock is recorded. And I would just disregard this one up here, guys, and use this one. Common stock is always recorded at par value. That's generally accepted in America. And so we have this account that we just throw everything else into called additional paid-in capital, anything over par. So in this case, we've issued 1,200 shares at 10, which would be 12,000 shares. So we're going to record the common stock at par value, and anything more that we get for that stock goes into an additional paid-in capital. We will again, in Chapter 8, we'll start talking about this one again. Okay? So I thought I would just kind of give you guys an overview of just a different perspective of what you're sitting there and what you're debiting and what you're crediting, and maybe a little sense of why you're debiting and why you're crediting a certain account, And so I just kind of giving you that sense. I want to talk over your solutions and just give you just like you're in a classroom and I've got it on the board and I'm just kind of talking to you like that. So we'll move on now to the next one.